Hello, my name is Richard Barwell, and on behalf of everyone at the MMF, I would like to welcome you all to our 6th annual policy conference. For obvious reasons, the structure is a little different this year. As you can see, we're meeting online, and the conference sessions are spread across 5 days rather than our usual one-day affair. But the objective of the conference remains the same. We're trying to bring together the entire UK economic policy community in one place, people from academia, think tanks, policy institutions, financial markets, and the wider private sector, to discuss aspects of monetary and financial policy with a deliberate focus on developments here in the UK. No apologies for the focus this year, it's COVID-19. And across the next 5 days, we'll discuss the pandemic from various perspectives. Today, we begin with the macro outlook, but over the next few days, we'll debate the impact on inequality, the implications for monetary policy, the scope for monetary and fiscal policy coordination, and the financial stability implications of the pandemic. I want to say a quick thank you to all the people who have given up their time to participate in our conference this year. We appreciate how busy everyone is, and we're extremely grateful to you. So, without further ado, I'm delighted to hand over to Clare Lombardelli, the chair of our first session, who will explain how today's session is going to work. Thanks. Over to you, Clare.
Thank you very much, Richard. Hello, everyone. My name's Clare Lombardelli, and I'm speaking to you from the Treasury. I'm going to welcome you to this session on the macro outlook. I'm delighted we've got a great cast of speakers for this afternoon. Each are going to share their views. We're going to have a panel discussion, and then there'll be a chance for you to put your questions to them. If you have a question, go to slido.com. The event code you need to enter is 888001, and then enter your question. Okay. We've got 3 speakers today. I'll introduce them to you briefly. So first up, we've got Janet Henry from HSBC. Janet's been the Global Chief Economist at HSBC since 2015, and she's had an illustrious career at HSBC with experience across much of the business. She's published extensively, including on issues such as the global financial impact of COVID and what this means for inflation in the short and medium term. Janet's going to set the scene for us. She's going to talk about the likely shape of the recovery out of lockdown and the key factors that will determine the pace of that recovery and the variation in macroeconomic performance across countries. Our second speaker is David Miles. David is Professor of Financial Economics at Imperial College Business School. He served on the MPC from 2009 to 2015. His current research focuses on policy issues around financial stability and the housing market and the setting of monetary policy. He's written on COVID and will share some of his research and analysis with us today on the debate about whether there's a trade-off between suppressing the virus and supporting the economy. What can economists say about the costs and the benefits of the recent lockdown, and what does this imply for the calibration of new measures in response to the next wave of this virus? And finally, we've got Valerie Cerra, who's an Assistant Director and Division Chief of the European and Middle Eastern Division in the IMF's Institute for Capacity Development. She's one of the main sources of empirical research into scarring following recessions, and she's written on scarring and COVID. Her work demonstrates empirically that scarring is near universal following recessions, and she will give us her views on the scale of the risks of hysteresis effects on the supply side, given the hit to demand that we've seen, through what channels, and what are the implications of this for the design of economic policy. So I'll start by handing over to Janet. Janet, would you like to take the floor?
Thank you very much, Claire. So can I just check that you can see my screen?
We can.
You can see the screen. Okay.
Thank
you very much. It's a pleasure to be here, and thank you all for joining. So as Claire says, it's my job to set the scene. And the title of my presentation is The End of the Beginning, which is how I describe where we are in the recovery process. And I suppose what I'm basically saying is that although it may not seem it, I think that what we've already been through may well prove to have been the easiest part of the recovery. And really, start just with this snapshot of what our global forecasts say about the outlook for growth from here and our growth forecasts for the major economies, which aren't particularly controversial. They're not too different from the latest numbers that were just published by the IMF in the World Economic Outlook. But although we don't have much Q3 data yet, obviously we had the China data this morning, it's quite clear that we have seen a bounce back in GDP in Q3, but that the pace of improvement is already starting to slow. And as much as we've got those really robust year average forecasts for 2021, there is no denying what we all know, which is that the level of activity for the next few years, at least, is going to be some way below pre-pandemic levels. We're still going to be, as I say, way below where we thought we were going to be back at the end of 2019. And what I want to do is talk about what have been the major drivers of growth globally, which sectors have outperformed, and then think about the outlook for GDP, where we go after that. So let me just start with what's already happened in the world's two major economies, which is, of course, the US and China. And I think all of this monthly data, which goes up to August, although we just had the September data this morning out of China, we can see very, very clearly that it's easier to get the goods side of the economy back on stream than it is to get the service sector side. Now, obviously, China was first into the pandemic, first out of the pandemic. It also has the advantage that it produces a lot of those things that tend to be in a lot of demand during a pandemic. So medical equipment, PPE, electronics, extra screens for all of us still working from home. And they've also performed on the outputs on the export side. And in fact, in line with that kind of goods rebound, goods trade has been much more resilient than service sector trade, particularly in areas of tourism and such like. But it's the same picture, even if you look at the advanced economies. It's the goods side of the economy, consumer goods spending, that's rebounded much more sharply than service sector spending, which has obviously been affected in particular by border restrictions, but also the mandatory or voluntary social distancing that is still in place in many countries. But it's not just in that area, it's not just the goods side versus the services side. The other area of outperformance that I would point to is, of course, the housing market, which has been widely documented is the area that's particularly unusual given the scale of the global recession that has come through. Again, I've just shown you major economies like the UK and the US, but we've seen this in a vast array of economies around the world. The number of factors contributing to that housing market resilience are numerous. Of course, we've got much lower interest rates and indeed negative interest rates in various parts of the world. We've had fiscal stimulus, whether it's stamp duty reductions, in particular in the UK have played a role, consumer preferences shifting away from cities. Everyone needs a spare room now to work from home. And of course, there's with I suppose fewer people planning to ever return to the office on a full-time basis, already a willingness to move further out of the cities. But the rebound has been, I think, not something that many thought possible back in March at the original onset of the pandemic, particularly when you look at that right-hand chart, which shows you that in the US, both new home sales and existing home sales are actually now at their strongest level since 2006. But in terms of where we go from here, before I come on to the fact that I think things were already starting to slow down, even in the course of the third quarter, the big risk from here is obviously the renewed rise in infections that has become increasingly evident across Europe over the course of the last month or two. And if we look elsewhere in the world, we can also see that there is a macroeconomic impact, even from very localized and geographically specific areas of restrictions. Now, we can see this in particular in some of the Asian economies. On the left-hand side, you can see the split, for instance, in Victoria and Australia. Now, Australia, like New Zealand, tended to react very, very strongly just to an initial sign as reinfections. But you can see, for instance, what happened in Victoria, where there was quite a definite labour market impact, but in a large, quite sparsely populated country with very little restrictions between the various states, actually other parts of the economy continued on their gradual recovery trend. But the right-hand side is interesting too. It shows you that in a country like Germany, actually, we did see the level of mobility on all of those Google indicators that we're all following with a large degree these days. It shows you that movement in retail, recreation, etc., had gone back above pre-pandemic levels. Now, just recently, with the rise in infections, not back to French or indeed Spanish levels or UK levels, but they have been rising. We've seen activity pull back. And in other countries where the economies continue to reopen, but people do not believe the public health situation is safe, we've certainly seen things not return back to those pre-pandemic levels. And I think that is the risk, even to those forecasts which I already showed you, which is, yes, in annual average terms for 2021, the level of activity is still going to be some way below where we were. And even if there's a lot of uncertainty over the course of the next few years, a couple of things we can still be very sure about is that employment demand is not going to be anything like what it was. And of course, debt levels are going to be somewhat higher. And let me just turn to consumer confidence, because obviously this matters for household savings in particular. It seems like most of the surveys that we see for the manufacturing sector, the manufacturing PMIs, even some of the business confidence surveys, they are still improving, but not the employment components. And in many countries, consumer confidence, which had shown an initial bounce in improvement, that pace of improvement has slowed, and in some countries has already started to fall back. For instance, in the US, the jobs hard to get index by no means showing a continued improvement. And this will really, the risk here is that it does restrain the extent of the consumer, the continuation of the consumer recovery through the course of 2021, even if we do see the second wave of infections start to be brought under control. And in fact, on the right-hand side, that chart of the household savings rate, we know that they are masking a high degree of income inequality, that savings rates never reached 33% for the entire population. But even so, yes, they are off their peaks, but they are still some way above where we were. And given that all of our projections for the coming year is that the pace of improvement in the unemployment rate in the US, the pace of improvement will be a lot slower from here. It will still be double pre-pandemic levels by the end of 2021. And across Europe, we're still seeing the lagged effect on employment. We think that unemployment rates could well be rising over the course of the next 6 months or so. That is likely to keep savings rates high and mean that consumer recovery, as I say, from here is likely to be slower. Now, I'll just touch briefly on the income inequality issues, because I know that's something that's going to be explored in later panels, but we know what's already happened. So far, the job losses have been concentrated amongst the lower paid, lower skilled, younger workers, female workers and such like. But we also know that it is starting to broaden. And in fact, when we look at some survey data like this one, it shows you, of course, actually that we're now starting to see some of the more normal jobs that are lost in the recession, the jobs that weren't lost because of the restrictions and the government lockdowns, but the jobs that are no longer going to be required in a world of a lower level of activity. So it could be that as these job losses spread away from what are called non-white collar workers, particularly as construction is reviving and certain areas of service sector activity are coming back, it could be that these subsequent job losses actually have a bigger income effect. And it will also mean that we could well see some renewed but later rise in delinquencies, especially when we're thinking about what will drive potential growth as we go through not just 2021, but into 2022 and beyond. I'm already talking about a world which potentially will have higher structural unemployment, particularly if there's an impact on younger workers that's much longer lasting. I'm also talking about a world of a lot of uncertainty while investment spending is going to be restrained, which will impact on productivity. But the risk is also that these is exacerbated by a tightening in financial conditions. And this is where it's very difficult to gauge in real time because, of course, there is so much in the way of government support schemes in various countries, and indeed a large degree of forbearance and mortgage holidays, and of course holidays and delayed repayments of things like student loans. To the extent that we have data, you can see in the US that the number of delinquencies, even among younger people, fell back. That was because people didn't have to pay their student loans. This is a delay rather than something that's been avoided, most likely. And in terms of corporate insolvencies, which is where there is a growing concern, given how much of the increase in debt in the last decade was in the corporate sector, the risk is again that this comes through with a lag. The US data isn't such a good guide here because of Chapter 11, but across Europe, whether it's the UK or Sweden or parts of continental Europe, this year, the number of corporate insolvencies has actually fallen. Governments can't take a view on who are the winners and the losers, but there have been less insolvencies in the corporate sector than any normal year in a strong expansion. It's only reasonable to expect that some degree of insolvencies come through with a lag, and that could ultimately impact on financial conditions, and along with the other factors restraining potential growth, that tightening in financial conditions could also play a role. And I'll just finish with a few words on inflation and for policy, because I know my colleagues in the panel will talk about the policy side in more detail, and indeed the scarring issues that I've touched on. But it is a question I get a lot. What about inflation? What about this huge policy stimulus that's coming through and that will likely be required to continue the recovery through the course of 2021? For the next couple of years, at least, I'm still in the low inflation camp. Beyond that, I think the risks are political. But we know that we're going to be in a world still of deglobalizing trends, and the production of certain goods will now come back home, not least medical equipment and certain technologies. That means that the story of the last 25 years is at risk. We've had 25 years of persistent goods price disinflation and persistent service sector inflation. Again, using the US as the example, the odd occasion when we have seen higher goods price inflation, it has not led to higher inflation. That happened in 2010 with a weaker dollar. It happened in 2018 because of US imports on China. And it's happened over the last year after this temporary dip in inflation in the midst of the pandemic as things have started to normalize. But we still think that inflation expectations in the US and in the Western economies are anchored at very low levels, with so much slack in labour markets. Unless there is political intervention to mean higher wage rises, inflation expectations being well anchored means that if we see higher goods price inflation, it's more likely to squeeze growth rather than to lead to uncontrolled inflation against a backdrop of higher inflation expectations. The risk is clearly fiscal dominance. And of course, central banks are still asking governments to do more, but they certainly don't want fiscal dominance. But this is the toolkit. Central banks are all telling us there's plenty in the toolkit. Again, I'm sure this conference will come back to this in a number of occasions. I don't think negative rates are in the Fed's toolkit. I think it's more QE and more forward guidance for the foreseeable future. And ultimately, if needed, yield curve control could come into play. Clearly, negative rates are in the Bank of England's toolkit, but we don't think they'll use them, even if they do cut rates once more to zero. Perhaps if there is a no deal transition end to Brexit. And for the ECB, we look for further asset purchases to be announced in December. Of course, the pressure still on fiscal policy. Higher debt, I know that's something we will discuss in the panel, but for the advanced economies across the board, eventually higher taxation rather than higher nominal growth will come to the rescue. But for the next few years, at least, a world of financial repression is our basic scenario. I'll leave it there and hand back to you, Claire.
Thank you very much, Janet. Fantastic overview of what we're seeing around the world in the economic data there across a range of sectors, whether that's the labour market, housing, financial, or otherwise. I'm sure we'll come back to many of the themes that you touched on there. Just a quick reminder for anyone who's got questions that you'd like to ask. To do so, you go to slido.com. The code for this event you need to enter is 888001, and then enter your question. Let me now hand over to David, Professor David Miles, who's going to tell us about the cost-benefit analysis of various policies.
Thank you very much, Claire, and welcome to everybody, wherever you are. I hope I'm going to be able to share my screen, so let me give it a go. And I hope.
Yep, that looks good.
Right, and even better if I do that. Do we go on a side? Hold on.
Yes, yeah, that's fine.
Wonderful. What I'm going to do is make some simple, possibly even simplistic comments, more as a way, in a sense, to get the discussion going about possible trade-offs of different policies in the face of the virus of COVID. And absolutely not that I think that there are any easy answers here on what the best policy might be, although I may, in a rather negative way, have some comments on what is not a good way to set policy. Before I do that, I just want to expand, excuse me while I do something on my own screen for a moment. Okay. Trade-offs. Policy, I think, in this area is pretty clearly generating trade-offs, and they're trade-offs which are particularly difficult because they involve health outcomes and potential lives lost. I think we can all agree, though, it's not a case of lives lost on one side of a balance sheet and what you might call narrowly defined economic costs, GDP lost, on the other. And the reason that it's not just that, and not even mainly that, I think is something that we all recognize, which is that restrictive policies to try and slow the spread of the virus, of which lockdowns, which is a vague phrase, but I might use it a few times. I think we all know the kind of things we mean. Those policies clearly reduce lives lost and misery in slowing the speed of the virus, but they also generate on the cost side health outcomes which are very serious and negative on the other side as well. It's pretty clear that people who are forced to stay at home, who may suffer unemployment, who may not get treatment for underlying serious conditions, will suffer both now and well into the future, beyond simply economic losses, health losses as well. One indication of that, a striking finding from a very recent paper, it's a CEPR discussion paper, one of the authors, one of my colleagues at Imperial, who many of you will know, Carol Proper, and they estimate that a 1% fall in employment leads to something like a 2% rise in the prevalence of chronic illness. So if you thought, as seems plausible, that highly restrictive policies on activities generate some cost in terms of lost jobs, then the estimate from the paper by Carol Proper and others would suggest that that can generate a very substantial health cost in the longer run. So for example, just using their central estimates, if employment now in the UK were to fall by as much as it did in the 12 months after the 2008 financial crisis, and that seems very likely, maybe that's already happened. My guess is if it hasn't already happened, it will happen sometime over the next several months. That scale of job losses on their estimates would generate something like 900,000 more people of working age predicted to suffer from a chronic health condition, an extraordinarily high number. As well as, I think, the indirect negative health effects of restrictions designed to reduce the spread of COVID and deaths directly from COVID, there is, of course, the economic impact. So it's not just on the cost side, we have future health costs to weigh against future health and current health benefits from restrictions. There's also quality of life as well as amount of life based on average incomes. And these are formidably difficult issues. There is an enormous amount of uncertainty. Just to mention two, optimal policy. If you knew when a vaccine was highly likely to come, that would have a major impact on policy, and we don't. If you knew the knock-on effects of those who recover from COVID but have longer-term health issues, that would also enter into any kind of design of an optimal policy. And we don't know very much about that either. I think the one thing it seems to me we do know is that any policy which simply focuses on what it does to the number of people infected and possible direct lives lost as a result of COVID, and simply focuses on that, is likely to be misguided. So where are we right now in the UK and indeed in many other European countries? As we all know, infections have been rising very substantially recently. I think the economic damage already done as a result of the first set of restrictions is substantial and may well mean that any further negative effects of restrictions is even more significant. I'm thinking there about companies that may be on the verge of insolvency or struggling along, might have been able to reopen, might have been able to get back to a healthy state if there are no further restrictions, but may well be hit by new restrictions that might be imposed. So the marginal harm done by more restrictive policies now may be greater than the marginal harm done by the first set of very serious restrictions brought in the middle of March. But it may also be that the benefits of restrictions are now very large as well, given the worrying trajectory that infections are on and likely deaths with some time lag after that. So what to do? The advice, which many of you will be familiar with, that was given by the SAGE group, largely epidemiologists, to the UK government a few weeks ago, on the 21st of September, was for what you might call a short lockdown or a circuit breaker, which, as I understand it, would involve widespread shutdown of many types of economic activity in the UK for a relatively short period of maybe a couple of weeks or maybe a little bit longer. That quote there is from, which I hope you can see on your screens, that quote there is from that advice, the summary of that advice back a few weeks ago, where SAGE very sensibly admits that the evidence base into the effectiveness and harms of these interventions is weak. They think that such restrictions, non-pharmaceutical interventions may need to be in place for a considerable period of time and repeated. And it would be good to know more about what the impacts of such restrictions might be. And they suggest where analysis would be particularly useful, studies on the impact of harms of interventions. Policymakers will need to consider analysis of economic impacts and the associated harm alongside the epidemiological assessment. One observation on that, and this is not meant to be an attack on epidemiologists, it's merely how surprising in a sense it is, remarkable you might say, that advice can be given on what the right policy is. A group which admits that there will likely be very substantial side effects of the recommended action, but without much idea what they are. And I think it's important to sort of stand back for a moment and think just how surprising that is. Medical people don't normally do that. They don't say, I'm pretty sure this is the right thing to do. I'm pretty sure there will be significant side effects. I do not know what they are, and it would be nice if somebody else could tell us. But meanwhile, here's what we think should be done. I want to say something very briefly about a bit of analysis, a very simple piece of analysis I did with a couple of other researchers a couple of months ago. It appeared, a version of it, in the National Institute Economic Review in August, on the potential benefits and costs of the severe restrictions that were introduced in the UK, indeed in many countries. I'm going to focus on the UK, back in March. And as you remember, around about March 23rd, although there had been some restrictions prior to that, major restrictions came, which basically said don't travel, stay at home unless there are truly exceptional circumstances. Great swathes of industry and of the services sector shut down. Shops were shut for many weeks. And I want to do a very simple analysis of costs and benefits of that. On the benefit side, let's assume that the main benefit is lives saved, where there is an enormous range of potential estimates of how many lives might have been saved as a result of that, what turned into an almost 3-month lockdown. The highest estimates, based on extraordinarily influential work by some of my colleagues at Imperial College, led by a team of Neil Ferguson's, estimated that if there were to have been no change in behaviour except for the restrictive policies of the lockdown, there might have been something like 500,000 deaths over the next few months. So what's the biggest estimate you could make of the lives saved benefits of the lockdown? It would be 500,000 net of how many estimated deaths actually we think occurred, which is of the order of 50, 60,000 perhaps. So that would give you something like 440,000 lives saved. And I'm going to make a very simplistic calculation and assume that given what we know about how old the people that have sadly died as a result of COVID, average age around about 80, given the comorbidities, I'm going to make an assumption that on average those people might have lived for something like 10 years, and I'm going to assume that they were all good years, which is probably an overestimate of the of what might have happened. So we gain 10 good years of life for as many as potentially 440,000 people, against which I'm going to simply measure the very narrow economic costs. I'm not going to think about future health costs from lockdowns. I'm not going to think about mental anguish. I'm not even going to try and estimate the cost of disrupted education for very large numbers of young people as a result of the lockdown. Simply how much GDP was lost, compare it with a way of valuing the extra lives that may have been saved. How to value the extra lives that may have been saved, a difficult philosophical question. I'm going to use the rule of thumb that's used by NICE when it recommends a rule to be used for deciding on whether new treatments in the NHS in the UK should be used. And that rule says, do not spend more than £30,000 on a treatment if what that treatment does is on average save one quality adjusted life year. So let me very quickly, with time running down, show you some numbers based on an assumption about how much GDP may have been lost as a result of the lockdown initiated in the middle of March. On that issue, at the time or shortly after it, the Bank of England, the OBR, thought that if there was an easing of restrictions after a few months and the economy bounced back, GDP might be lower by something like 14, 15%. In some ways, that now looks a little bit too pessimistic, because it seems more plausible perhaps that GDP in the UK this year might be down only 10%. Of course, relative to a belief that it might have risen by 1.5 or 2%, that still loses you 12% of GDP. But it's very unlikely we will have bounced back, even without any further restrictions, by the end of this year. Now, the conventional forecast, the wisdom would seem to be that we're lucky if we get back by the middle of next year. So I think 14% of GDP lost during this year and not having recovered much of it by the middle of next year still looks not implausible. Of course, the big question is, well, how much of that was due to the restrictions and how much would have happened anyway because people got nervous? That's a very worried about the health situation, didn't want to go to work, didn't want to leave the house. I'm going to assume, it's very crude, that the government restrictions basically said, do not leave your house. Schools are going to close, universities are going to close, most things were closed. actually generated a lot of the very sharp downturn in activity in March and into April. And that if one thinks that maybe 13–14% of GDP lost is an overall impact of the virus as it was spreading in the middle of spring and into the middle part of this year, that perhaps a half or 2/3 of that was as a result of government mandated restrictions. That would then mean that that GDP cost would be of the order of £200 billion or so. So very quickly onto this overcrowded table, let's just look at the first column here, where I've assumed that the narrowly defined cost, just the GDP loss, is of the order of £200 billion. That's that first column there. The benefit side, I'm simply going to use the NICE rule, pay up to £30,000 to save one quality adjusted life year, and then use the potential number of lives lost in different scenarios. The absolute highest I think you could get to is plausibly 440,000. And applying that £30,000 per quality number, you get a benefit number. So each cell in the first column has a positive number to start with, 132 billion in that first cell. That's 440,000 lives saved, 10 years, good years of life saved for each life saved, £30,000 using the nice number applied to that gives you 132 billion. GDP cost 200 billion. It's a negative number. Every single number in this matrix is negative. What that means is that you would, if you buy into the many assumptions that generate these numbers, have to value one quality adjusted life year at maybe 2 or 3 times the nice number in order to start generating any numbers that weren't negative on this very narrowly defined estimate of costs and benefits. I think that's an illustration that there very likely are extremely important trade-offs to be considered in this area. Finally, just let me spend 2 minutes on a more forward-looking set of observations. One is that I think the literature in this area, which many people will be familiar with, the literature in this area suggests that what you might call blanket policies, total lockdowns applied throughout an area to people of different ages and across different regions, which may have different rates of infection, is unlikely to be an optimal policy. I don't think I've read a single paper, policy paper in this area, and there are hundreds, possibly even thousands written now by sort of the crossover between economics and epidemiology. I can't think of a single one which says that a uniform lockdown applied for a significant period of time beyond maybe a short period like a week or two is an optimal policy. Nearly every paper says, no, you should differentiate if it's by risk or possibly by region. So I think the reintroduction of a blanket lockdown, such as that took place in the UK after March 23rd, seems unlikely to be warranted. One final observation, if I may, which is the most positive thing I will say today, is that I think the one hopeful, and I think it's actually very hopeful, possibility on the horizon is the development, and they are in development, as many people will know already, of very fast tests for whether or not people might be infected. And by very fast, I mean like pregnancy tests. Take the test, wait 10 minutes, look at what's in your hand, yes, no. The worry that some people have, and perhaps what may hold back these kind of emerging technologies of fast, cheap tests, the worry is that they're not very accurate. And I want to finish on a positive note, which is I don't think it matters as much as people claim that these sorts of tests may not be terribly accurate. And the reason is that if such tests really are widely available, and they're very cheap, and people can undertake 2-3 tests even in one day, and simply apply saliva to a screen or even a piece of paper, wait for it to change color and it says yes, no. You do not need those tests to be very accurate. Let me just leave you with one thought. Let's suppose people worry a lot about the false negative. You are infected, you take the test, it says you're not, but actually it's only 80% reliable. That's very unreliable by the standards of almost any medical test, extremely unreliable. Take two. If you take two, each one is 80% reliable. That becomes a 96% reliable test. If these things are available very freely, very cheaply, with quick results in 10 minutes, I think it absolutely transforms the situation in a good way. And I do hope that they are not going to be held back by people applying disproportionately risk-averse assessments of how accurate they need to be. Because if you can do more than one in a day, anyone doesn't need to be that accurate. Let me stop at that point. Apologies for running over a bit.
Brilliant. Thank you, David. A lot of really interesting analysis there that you've shared with us that touches on a number of quite tricky decisions and issues that that many people are thinking about at the moment. Let me finally hand over to our third speaker, and that's Valerie Cerra from the IMF. Valerie, the floor's yours.
Thank you. All right, do you see the slide?
Yep, that's good.
All right, perfect. Okay. So first, I'd like to thank the organizers for kindly inviting me to talk today about the risks and channels of economic scarring and the implications for design of economic policy. I'll be taking more of a global perspective. And please note the disclaimer that the views I present are mine and do not necessarily represent those of the IMF or IMF policy. So let me start with some background. The empirical evidence suggests that economic crises and recessions have scarring effects on the real economy, which we also call hysteresis. My co-author Shweta Saxena and I showed that financial crises lead to permanent output losses of between 5 and 15% on average, depending on the type of crisis. More recently, Ma, Rogers, and Zhao looked at previous pandemics and epidemics. They found that output was still 3% below its pre-shock trend after 5 years. And those episodes were much less severe than the current pandemic. I also have a recent IMF working paper that reviews the literature on how temporary shocks, including demand shocks and macro policies, can feed through to the supply side. So just to summarize a few of the channels, a recession can reduce labor demand in the aggregate, or it can change the composition of labor demand in terms of skill levels or regions. Job losses can translate into human capital decay over time. And various labor market policies and institutions can impede the adjustment back to full employment and labor force participation. Recessions can also reduce incentives to invest and to undertake R&D because firms' expectations of demand are low currently or in the future. And an impaired financial system can disrupt the supply of credit, which in turn hinders investment. In fact, some research suggests that cohorts that enter the labor market during a recession suffer significant scars in terms of persistent declines in earnings lasting at least 10 years, as well as worse health and higher mortality rates. So turning now to the impact of the COVID-19 pandemic, obviously the most important scarring effect has been lives lost. As of now, the number of confirmed COVID deaths exceeds 1 million people globally. So these lives are gone forever. And many COVID survivors will also have lasting health problems. The pandemic's also having a heavy toll on the global economy. So to start with, the COVID shock has sharply increased liquidity and solvency risks, especially for small and medium enterprises, relative to a no COVID baseline. The share of SME jobs at risk due to illiquidity has risen the most in accommodations and food and other service sectors. The OECD estimates that hours worked have plummeted by 15% during this crisis, and that job losses have been 10 times larger than those during the global financial crisis. According to the IMF's World Economic Outlook, both lockdowns and voluntary social distancing contributed to fewer job postings, especially in contact-intensive jobs like food and hospitality. But notice that job postings fell well before official lockdowns. So this demonstrates the impact of voluntary social distancing to avoid infection risks. And the bottom chart on the right shows that removing stay-at-home orders did not generate any noticeable rebound in job postings, not even in the manufacturing sector. This loss in employment has been worse for some sectors and demographic groups. For instance, a higher share of women than men are employed in the social sectors, and those have been most impacted. This is translated into a higher unemployment rate for women than men. And youth unemployment has also soared relative to that of adults older than age 25. Research shows that past pandemics have led to an increase in inequality relative to the pre-pandemic trend. And the rise in inequality is partly because of a decline in the employment ratio for lower educated people. Those with advanced educations were barely affected. And we see this happening now in the COVID crisis. So the rise in inequality is another channel through which output scarring can take place, because past research has found that higher inequality leads to lower growth. The global recession also entails lower fiscal revenue. So that, combined with higher public spending to respond to the crisis, has lifted general government debt to a historic high. It's matched only by its level during World War II for advanced economies. The IMF's fiscal monitor shows that total public and private sector debt of the G20 has already reached nearly 240% of GDP by this year. So according to the IMF's Global Financial Stability Report, corporate vulnerability is also rising. So firms borrowed during the shutdown to maintain their liquidity, but for many countries, corporate debt is now at the top of the range of the past decade. And although banks entered this crisis with reasonable buffers, some banking systems could suffer significant capital shortfalls if many firms and households are not able to repay their loans. Now, despite these several scarring channels I just discussed, there are some mitigating impacts from the massive policy responses that countries have undertaken. So first of all, monetary conditions have continued to ease. Policy rates and expectations, as well as sovereign yields, have declined in most advanced and emerging market economies. Major central banks have also expanded balance sheets by $7.5 trillion. And governments have also responded to the pandemic with an unprecedented $12 trillion in discretionary fiscal stimulus. So this is averaging about 12% of GDP. And the stimulus has been especially high in advanced countries. So measures have included wage subsidies and job schemes, cash transfers, and social benefits for households, and as well as loans and equity injections for firms, among other measures. Now, before COVID hit, global extreme poverty was expected to continue declining as it had for the past few decades. Unfortunately, the COVID crisis is expected to reverse this trend and push more than 100 million people into extreme poverty. Well, in most regions, governments have expanded social assistance, especially in the form of cash transfers. So this social assistance to the poor is expected to offset the rise in poverty, but only slightly. The net rise in extreme poverty is still projected at 80 to 90 million people. Technology has been helping during the crisis. For instance, government cash transfers to households have been aided by the rise in mobile money service providers over time, and especially in sub-Saharan Africa. A number of countries have put job retention schemes in place. And so you can see the take-up has been considerable. It's averaging 1/4 of employees. In contrast, some countries have announced substantial loan guarantees for businesses, but that take-up has been relatively low so far. Now, complementing these domestic policy actions, the international community, including the IMF, has also stepped up its support. Since the beginning of the pandemic, the IMF has provided emergency financing to 81 countries, committed over 100 billion so far, and has also been working with 29 of the poorest countries for debt service relief. So finally, let's look ahead at the forecast and the policy implications. The World Economic Outlook projects a partial recovery, mostly driven by China. So it's natural to expect some bounce back as lockdowns are eased and after effective vaccines or therapies are developed. But even so, scarring of about 5% and 8% is projected for advanced and developing countries respectively. Cumulatively, output losses are projected to grow from $11 trillion through next year to $28 trillion over the next 5 years. And sticking with this 5-year ahead forecast, we can see in the graph on the left that for most countries, the output loss after 5 years, which is shown on the vertical axis, is expected to nearly match, or in some cases exceed, the output loss after 2 years, which is shown on the horizontal axis. So this is a significant amount of scarring and represents a setback to the pace of improvement in living standards. And the cumulative growth in per capita income is projected to fall by several percentage points for all country groups. So what policy actions will be needed going forward to minimize scarring and build economic resilience? Well, in the short term, obviously policies should continue to focus on saving lives and providing income support to individuals and firms, and the international community should continue to help. Over the medium term, macro support will still be needed to underpin the recovery. This will eventually have to be balanced with addressing rising debt and emerging stresses in corporate and financial sectors. So my past research with colleagues, we found that a range of macro policies can, in fact, help speed the recovery and reduce scarring effects. In other recent IMF work, it reveals that public investment has strong multiplier effects, especially during recessions and periods of uncertainty. In addition, IMF staff estimate that public investment on R&D, green electricity, and efficient buildings can generate twice as many jobs as spending on traditional infrastructure. So once the pandemic subsides, policy will need to shift its focus to building resilience and addressing the many critical issues like inequality, climate change, governance, and structural transformation. And this crisis highlights the need to improve health systems and social support more broadly, especially to protect the poor and less educated, as well as informal workers in developing countries. And in addition to green infrastructure, governments can promote structural transformation by investing in digital connectivity. So this can increase private sector productivity and even help landlocked countries diversify their production and export bases. And as we've just seen, digitalization can facilitate the delivery of social assistance, among its other benefits. Then to take advantage of technological advancements and allow everyone to benefit, governments will have to ensure high quality education as well as retraining programs. So let me stop here and turn it back to Claire, but happy to answer questions.
Thank you very much, Valerie, and some pretty sobering analysis there for all of us. Just to remind people on how to ask questions, if members of the audience would like to ask questions, you'll go to slido.com. The event code is 888001, and then enter your question. Before we take questions from the audience, we're going to have a bit of a discussion amongst the panelists. I can start who I'm expecting to appear on the screen. Let me start with a question for each of you. You've all set out different perspectives on what we're seeing. I wanted to ask each of you how your perspective on this crisis has evolved since the start, and if you'd given your presentation to us in March, April of this year, in what ways would it differ from what you've told us today, and in what ways would it be the same? Would anyone like to volunteer to go first, or if not, I can pick someone.
I'll have a go at that one, Claire. I mean, it's really hard. I mean, March versus April is quite a big difference. But I suppose in March, we shouldn't downplay, how much policymakers succeeded in averting something, quite a lot worse. We didn't have, I suppose, the complete seizing up of financial markets. We certainly had the threat of it, particularly in some emerging economies. But the speed with which central banks came through with a policy stimulus, particularly the Fed, in a way that for a few days was just completely unprecedented. I think that prevented a huge amount of what could have been somewhat worse in terms of the financial market channel that's come through. And the truth of the matter is, like a lot of international organizations, our own forecasts for 2020, we've lessened the degree of contraction in GDP in 2020 than we had at the worst point in our forecasts. But in terms of the general story, it's more or less unchanged. Bits of it, we hadn't anticipated the strength of housing markets, perhaps hadn't anticipated the full strength of financial exuberance, but the broad scarring view of 2021 is broadly unchanged. And at the same time as lessening our contraction in 2020, we've lessened the scale of the rebound that came through.
Mm-hmm. Okay, can I ask you, Janet, just to follow up on that? You talked a bit about China and the position of China at the moment. What's your view now, and how would that differ from before, about how countries are sort of coming through this and coming out of it in terms of relative performance?
Well, I think that's what's been quite interesting, hasn't it? It's been the kind of Western, more capitalist economies that have provided the most support to household income, either by directly through workers or through supporting them, in some cases in the US, paying them more when they're at least temporarily, if not permanently unemployed for the first few months than they had been when they were fully employed. China's policy was more about supporting public investment. Now, obviously, it depends how much of that investment proves to be productive over time, but potentially that could mean, more positive side for potential growth. And I suppose, as I mentioned, China had the advantage of going in first, going out first, seems to be getting control of the pandemic, and because of the product mix it produces, it's clearly had a stronger rebound. But even in China, the pace of improvement is slowing down. We've seen that early bounce back, we've seen that quick bounce back, but it is the only one that probably will see a much quicker return to pre-pandemic levels of activity. And a lot of it is how they've handled the public health situation and how they have handled the policy mix, I would argue.
Thank you. Yes, please.
To me, four things have happened over the last 6 months which change in different directions one's view on what the right policy is to face this disaster. Firstly, track and trace has been very disappointing. I think we all understand that now. There was more hope back then that it would be much more effective, and it's not been. Maybe it'll get better, I don't know, but it's not working very well at the moment. Second, I think the assumption that most people made back then was that if you recovered from COVID, it was kind of over. And now we have to worry about long COVID. And that increases potentially significantly the damage of more people becoming infected. It's not just a question of as long as you recover, then you recover. And if you're not dead in 3 weeks, you're okay. Doesn't look like that anymore. I think the other thing for me that's been a bit of news is that I had hoped, not that I'm in any way a medical expert, but just listening to others who are, that now, back in March, we might have hoped that by October, we would be pretty close to a vaccine and maybe we could start rolling it out in early of next year. And that now does not look so likely. That's, I think, very significant, because the strategy of incurring very substantial costs in the short run by locking things down in order to wait for a vaccine is a much more sensible strategy if you have a high probability of a vaccine coming quickly. And to me, that looks a bit less, I'm a bit less optimistic about that now than I was in March, because in March, I thought by now we'd be very close to that. Final thing, bit of good news. As far as an amateur, I'm able to tell, there do seem to be some major breakthroughs in terms of very quick tests. Spit on the thing, look at it, you get a result, 10 minutes, it's in your hand, you go into the restaurant, you don't go into the restaurant. If that is available widely within a few months, that has the potential to drive down the infection to very low levels very, very quickly.
And David, can I ask you just to follow up? Has your view on your sort of cost-benefit analysis approach, has your views on that sort of evolved since the start of this pandemic?
I've learned a lot more since I did the sort of these rather simple calculations about what is an extremely large literature on how you value lives saved. It's clearly the case that the rule that NICE use is at the low end of estimates that are used across the world. So value of statistical lives, quite often in the US literature anyway, people put that value at $10 million. Now that's for a whole life. The quality analysis is for what resources might you spend to, in probability terms, save one life-adjusted year. So if you thought that a typical life was 70 or 80 years, and you were saving the life of a young person, then applying the 30,000 number, you get 80 times 30,000, you might get £2.5 million pounds, so maybe it's $3 million. In the US, they typically use $10 million. So the NICE rule is, whichever way you look at it, at the low end of what you might call the resources you might be prepared to sacrifice to, on average, generate one quality adjusted extra year of life. But, and some people think that's a knockdown argument for the type of calculations that I was showing earlier, which suggested that the cost benefit analysis of the first lockdown was not terribly favorable. Nonetheless, £30,000 is not a number we've talked about this, Clare, it's not a number arbitrarily plucked from the air. It is the number that's used for health decisions in the UK.
Indeed. Thank you, David. And finally, can I ask the same question to Valerie? I mean, you presented a lot of scarring analysis, which, you know, arguably you could say is the least, in a sense, sensitive to the details of the pandemic and how it's involved. But interested, Valerie, in your view, and whether your view of scarring has changed as we've seen more about how this crisis is playing out.
Well, I would say that, well, first of all, to answer your earlier question, relative to when the pandemic first hit, I suppose that I've had offsetting changes in my view. One is, I think we all expected the curve to flatten more quickly than it has, and we didn't expect the continued second waves, and so that's on the negative side. On the positive side is all the policy stimulus that we've seen that I mentioned in the presentation. Truly unprecedented. Now, how that relates to my research? Well, you know, we have to be careful that we're not always fighting the last war, right? So some of the research that I've done is focused a bit more on financial crisis and the scarring effects from that, although we've also found it to generalize to recessions that were not associated with banking crises. And clearly, this crisis is a little bit different because some of the fall in supply and demand are forced by administrative measures, by official lockdown. So you could say the supply is there and the demand is there, they're not allowed to match. So naturally, when those lockdowns, those administrative measures are removed, there will be some bounce back. But as time goes on, and since it is taking a long time to get this under control, and we wait for effective therapies or vaccines, you are seeing gradually this is translating into more of the standard macroeconomic variables on the labor market and the corporate sector, and potentially eventually to the financial sector.
Thank you. And I wanted to pick up on some of the discussion that Janet started at the end, towards the end of her presentation about policy. Janet, where you talked about kind of fiscal and monetary policy. And so I sort of wanted to pick that up and ask each of the panel members what they expected to see over the coming period from fiscal and monetary policy. Janet, would you like to start?
Yeah, is that a global question, Claire, or is that?
Yeah, well, either actually. Be interested both for the UK and more generally.
Yes, I suppose at least for the advanced economies, we're basically talking about a world where governments will have to do a lot of the heavy lifting from here on the policy side, but that they will continue to be backstopped by central banks. Because advanced economies have the luxury of being able to do that. They have, you know, a long track record, a lot of credibility. They're not under pressure from markets. Inflation expectations are low and very well anchored. And you know, as much as the Fed is certainly sending a signal that they are willing to overshoot for a period, having undershot for so long, the ECB, you know, certainly the financial markets does not think that it's got the same desire. Beyond the Fed and the ECB, the smaller advanced world central banks, I still think they're in a similar world. To some degree. So yeah, fiscal policy still doing a lot of the heavy lifting and still more likely to ease than to think about normalizing policy in the course of the next couple of years. It's in the emerging economies, I think we may see more pressure. I don't think they, you know, obviously they've been pursuing a lot of the emerging developed world style policies in terms of the scale of their bond purchases. Their fiscal positions are a lot more vulnerable, and at some point, they will be obviously facing more in the way of restructurings, as Valerie touched on, or indeed be forced into some kind of austerity. But in the advanced economies, it's monetary and fiscal policy working together, at least for the next couple of years.
Thank you. David, I wonder if I could turn to you and ask you the same question. You were a monetary policy maker in the UK for a very long time, and obviously have thought a lot about fiscal issues. What's your take on the what we should see from macro policy through the coming period?
I think the scope on the monetary policy side to try and offset the sort of ongoing impacts of COVID are pretty limited. They're limited in the sense that I'm very, very doubtful of the value of sending interest rates into negative territory. I think it's quite plausible that it might backfire. At best, it'll do very little. It might actually be a negative impact. So I think we've sort of run out of tools on the interest rate level side. I think the best that the Bank of England can do is kind of what it has been doing, which is in the face of unexpectedly large issuance of debt, of gilts. If there's what you might call indigestion in the market for a short period, then it can help smooth that by buying some gilts. On the fiscal side, I think that has to be the main response to the damage that the virus is doing. I think in some ways the situation is in the short term marginally better than it seemed a few months ago, because the loss of GDP this year might be a bit less than we had thought. But actually the worst news is that the recovery looks like it's being pushed further down the road in terms of when might one get back to a level of GDP that one might have expected before the virus came along. And so I think whichever way you look at it, it's highly likely that the stock of debt in the UK is going to carry on rising. Thank goodness it's happening at a time when the cost of government debt is pretty much at an all-time low for now.
Thank you. Valerie, can I ask you the same, if you've got any thoughts on the same issue, which is, this question of macro policy settings and what they should be for the coming period?
Well, yeah, clearly, as Janet and David mentioned, there may be less scope for advanced countries on the monetary policy side, as policy rates are already close to zero. Perhaps there's more scope for increasing balance sheets. And naturally, the response will continue to be focused on fiscal policy and fiscal measures to react to the health crisis, as well as to provide income support both to households and firms. There's scope for that in advanced countries. There's probably still some scope but it varies case by case among emerging and developing countries. And I expect that particularly for lower income countries, they'll still need to be backstopped by the international community. And I expect continued efforts underway to help with that. For example, there are initiatives to relieve debt service, and some of these measures have been extended. So hopefully the international community will come through as well.
And if I may, given your analysis and research on scarring, what does that tell us about the nature of the sort of fiscal policy we should be looking to? Is there any things that you think fiscal policy should be particularly trying to do or particularly not trying to do in tackling some of the longer term challenges that come from this?
Yeah, sure. Well, there is obviously a difference between the short-term and long-term challenges. The short-term challenge is really to address the health issue, as we've been discussing. Until people are willing to go out in public and until the risk of infection declines, you'll still see that firms will not be willing to invest or to hire. And we saw that in one of the graphs that I showed. Now, as a lot of the research the IMF just put out demonstrates that there is some scope to think about these longer term challenges, especially challenges like climate change. As the governments are looking for stimulus measures to increase demand and increase jobs, it's sensible to direct some of that to those longer term challenges and build green infrastructure. As we saw, that will increase the number of jobs. It'll also put money into the economy. And as my research has shown, that you can actually reduce scarring when you have macroeconomic stimulus. you find a very different response when countries in the past have responded to a crisis, even a financial crisis, with macroeconomic stimulus.
Brilliant. Thank you very much. Now, I think we've got the opportunity now for some questions from participants.
We have. Hello, everyone. I'm James Mitchell from the University of Warwick, and it's been my job to look at the questions and read from the audience. And we have received some, so thank you very much. And it's my job to try and relay those questions over to you. So I will start with a question ostensibly for David, but perhaps Janet and Valerie will want to comment on it too, because I think it bears on recent research by IMF and others showing that the economic effects of voluntary social distancing due to people's perceptions of health risk are significant. And so perhaps it's not just mandated lockdowns that matter, especially so now. But the direct, so that's to give Janet and Valerie a bit of time to, a bit of a heads up. But the explicit question to David was, if and how is your cost benefit analysis affected by emerging evidence that countries which did better in saving lives also lost less GDP?
It's absolutely right that that what you might call the hit to GDP would have been a significant hit, even if governments had said, fine, get on with it, make your own choices, because people would have got increasingly worried and they would have stayed at home and would have spent less, and that's undeniable. Of course, what happened, again, being parochial and just think about the UK, when the restrictions started coming in, which is, I think the government started announcing things around about mid-March, and then what you might call the complete lockdown, almost complete lockdown, comes on March 23rd. So there was quite a lot of announcements pre the March 23rd date. Some people, when you look at what was happening to travel in the UK and spending patterns, they began to change a week or so before March 23rd, but then the government was announcing before March the 23rd. I think it's quite tricky, what I'm saying is that it's quite tricky to know how much was a response to government restrictions and how much was, well, people would have done that anyway. What I can say, just on the cost benefit analysis, if you look at the first cell in my big matrix of numbers, it was, what's the maximum number of lives one might have saved by that lockdown? That comes from the Neil Ferguson and his team at Imperial College of epidemiologists analysis of what might have happened had there been no behavioral change, 500,000 people die in the UK. So if you want to do a cost benefit analysis consistently, that enormous number, which is a huge benefit of a lockdown, 500,000 or so lives saved, minus the ones we actually saw, you have to, on the cost side, say, if there had been no behavioral change, what would have happened to GDP? So my cost benefit analysis says, no, let's just take a big chunk of GDP loss that would have happened anyway, but still allow what you might call the Ferguson number, you save 500,000 lives. So it's been very generous toward the lockdown strategy, the way I've just computed those simple numbers.
Okay, thank you, David. So Janet, Valerie, this is optional, but I don't know if you've got anything you want to chip in on this, specifically that sort of, I guess, behavioural response, how one might measure it, what the policy implications might be.
Yeah, I think it's a very interesting question. Because I agree with David that one doesn't necessarily want a blanket restriction. And I think here from my experience in the county that I live, even when the lockdowns first came into place back in March, April, they were never complete. You were still allowed certain amount of activity. You were permitted to go to the grocery store, you're permitted to go to the hospital. It's really a matter of the voluntary social distancing, which also brings with it the loss of GDP. So it's a little difficult to say that, you necessarily increase GDP by not putting in place lockdowns, because if what that does is induce people to go out and more people get infected, then that would have a second round impact on increasing the risk aversion in the remaining part of the population. So I don't know how you would go about calibrating that, but clearly this is a more complex set of behavioral equations. So it's not just the people that are forced to stay at home, but also the ones that choose to stay at home, and their behavioral reaction depends on what they see as the number of contracted cases. But we can say, when we think about economics, that this is a classic externality, that people deciding to go out and have contact with others will take into account the impact on themselves, but not necessarily the impact on others. So surely there's a role for public policy to be more restrictive than what an individual himself or herself would choose. But then how that creates this complex of behavioral, this chain of behavioral effects is more difficult to calibrate.
Thank you, Valerie. Janet?
Yeah, I'll just make a couple of observations. I think this, and it's just in terms of what I've seen around the world. In some countries, it depends on the sectors they're exposed to. You know, Spain has such a huge dependence on tourism, and that's one where the social distancing as well as the border restrictions have certainly played a role. But I would also say, you know, there seems to have been a link in certain countries between the government being on top of the public health situation absolutely lessens the requirement for voluntary social distancing. And I would point to Germany and New Zealand in that regard. Obviously, Germany's in a slightly different situation now because it's also seeing a renewed rise in cases. But in the inertial stages of reopening, because they got on top of the public health situation and were perceived to be on top of it, it had a much quicker rebound. And in New Zealand, because on a handful of cases, they shut down that part of the country immediately. The rest of the country, there was no evidence of a kind of, voluntary social distancing because of this perceived confidence in the government's handling of the public health situation.
Thank you. Okay, I've got a question, somewhat related perhaps, from Jonathan Haskell. Again, ostensibly for Janet and Valerie, but be interested if David's got any views on this too, and what the economic, well, I guess we've already seen what conjectures of what the economic implications are, but what, if anything, Janet and Valerie, were you assuming about when a vaccine will be introduced?
In our forecast?
Yes, I assume, yeah.
I must confess, we have not put in widespread usage of the vaccine in a specific quarter in our economic forecasts. I suppose, you know, most of the analysis that we see from international organisation and from others is what happens in a second wave. And we hadn't really assumed even the renewed rise in infections that has already become apparent over the course of the next month, but nor have we assumed that there is a widespread rollout of the vaccine by, you know, for instance, the middle of 2021. But we have broadly assumed that it's more or less under control, I suppose, by the end of 2021, and that our forecasts for 2022 are more driven by our views on scarring. But the truth of the matter is we still don't know whether it's just going to be a second wave or indeed there's no permanent immunity whatsoever, in which case localized lockdowns and renewed resurgences of infections just could become something that, you know, affects human behavior for several years, if not longer.
Okay, thank you. Valerie, on what the IMF's assumed, or?
So the forecast that I was mentioning comes from the World Economic Outlook, and that is an aggregation of forecasts from all of the different country teams and at the institutional level. So look, we're not necessarily experts in epidemiology, so we take our views from what we hear. There's not, as far as I know, an explicit forecast on that built in. But I would say that what we hear is that perhaps by the end of the year, optimistically, or early next year, the vaccine might be available, but it will still take months in order to distribute it. And that's just in the US. It may be more difficult in many other countries.
Okay. So I'll give an option that was there for if David, the question was directed more at Janet and Valerie, but David, there was certainly, as ever, interest in from the question forum on the QALYs. Always attract attention, of course. And so sort of summarising a couple of the questions that came in on that and trying to bring them together, you were asked, what would the QALY have to be to break even? I guess, you know, I take that to mean what would the QALY have to be for the losses in GDP in some sense to be worth it? Another questioner relatedly referred us to some work by Halls, Jones and Kleno that no doubt you're aware of, that shows that 1 year of life is worth 6 times 6 years of consumption. And does this in fact justify the stricter lockdown measures that were in fact applied?
To answer the first part of the question, how much more than the £30,000 a QALY NHS resource rule, how much more than that would you have to pay for the lockdown to have sort of broken even? If you take the middle assumption about the number of lives that were saved and the number that I was working with on the GDP loss as a result of restrictions, you'd need about 6 times as high a valuation of a QALY as is used by the NHS to break even. Now, you're right. Lots of people say, oh, the NHS number is silly. People value lives far more than that. That may be right. Of course, there is a bit of a puzzle if it really is the case that people value treatments by the NHS that would, on average, save 1 QALY multiple times higher than the NHS rule. Then that might suggest that spending on the NHS in the UK, if it reflected the preferences of individuals, would need to be not a few percent more or even 10 or 20% more, but sort of 3 times as big. And then you have to ask the question, well, why doesn't the party that runs on a platform of NHS spending should be 40% of GDP in the UK not win a landslide? You also have to ask another question, which is, let's suppose the NHS has got it so spectacularly wrong, it is undervaluing treatments on an enormous scale. Would one then not expect people to scrimp and save and spend very large amounts of money on private healthcare, more than the few percentage of points of GDP that people spend on private healthcare? So I think you do sort of run into some puzzles if you want to really push the line that people value something that on average would generate 1 QALY on a scale that is, 7, 8, 9, 10 times as high as the NHS rule.
Okay, thank you. Well, in the interest of time, I'll pose perhaps one final question. Seems to be it's quite a big question, so perhaps in the interest of time, you'll be able to sort of condense answers. But this is a session on the economic outlook and adopting a sort of an international perspective. A few of the questioners were asking about some things, of course, we've discussed a bit already, why the infection rates and recoveries are so different across the world. And what does this imply for the economic recovery profiles across the world? But perhaps being a bit more sort of specific, in a few words, where do you think the major risks now are? And indeed, what do you think the sort of exit strategy of different policymakers across the world might be. As I say, you may choose to focus your answer on a specific country or region in the interest of making this very broad question somewhat more manageable. So in no particular order, be grateful to hear your thoughts on that somewhat open-ended final question.
Well, let me very, very briefly, just in terms of what are the big risks, and again, being slightly parochial in the UK, the big risk, I think we all understand what they are. They are, vaccine doesn't come along, maybe for a year, 2 years, maybe longer. No improvement in quick testing and tracing people who've got it. And we get increasingly bad news on long COVID. That's a horrible combination of things. But if you ask what the risks are, those are pretty high up. Plus, to be ultra pessimistic, that we discover, sadly, maybe quite soon, that there are a very, very large number of firms in the UK, smaller firms, who just are not going to come back from this. So there's huge amounts of things to worry about. But not to be too depressing, I really do become encouraged when I hear people talking about the advances that are being made in these quick, crude, not terribly accurate, but immensely valuable tests.
Thank you. Valerie or Janet, any final comments?
It's a really long question to answer very, very simply. But I think it is just an enormous policy challenge for everyone, isn't it? Even in the advanced economies where governments have the ability to borrow vast amounts of money, the longer this goes on for, the more that we have to, keep imposing localized measures, keep more companies alive for longer. There is the even longer term challenge. Yes, of course, there is the degree of zombification that could come through before eventually certain companies, become insolvent. But there's also the risk of pulling away too quickly because, companies that would have been viable might have still been able to employ people. So, yeah, calling the policy timing against the medical backdrop is absolutely where the risks lie, both in the short term and over the longer term, in terms of the impact on scarring and potential growth over the longer term.
But despite your mention of financial repression in your talk, are you, expecting inflation to be such that could encourage interest rates up and then sort of increase those risks, those vulnerabilities you spoke of?
I think inflation becomes a risk. It's a political risk. When I talk about financial repression, I'm talking about a world where interest rates stay low for really, the foreseeable future. Inflation stays low, but real interest rates are still negative. And so debt service costs for governments are extremely low for quite an extended period. If during that backdrop, we get a shock to inflation expectations, perhaps because of intervention on labour markets, whether it's, change of governments, whether it's in the US or in Europe, that leads to a much bigger rise in wages, and somehow governments, companies are in a position to pay it, despite the pressure on the margins. That's where the shock could come from. But I suppose, no, for the next couple of years, it's a more mild version. It's just the kind we've been used to for a while. Low long-term interest rates, just slightly less low inflation. That's what I'm talking about by financial repression in this world where central banks have to backstop governments.
Yeah, well, thanks for clarifying that. And finally, but not least, sorry to leave you waiting there, Valerie, any final thoughts on that somewhat large final question?
Well, I think a lot of my presentation addressed this, but very briefly, on top of the health risks and the risk that we don't get a vaccine or treatment soon, there is, as Janet mentioned, also the risk of a downturn lasting much longer than expected. There's, of course, as we go along, there's building debt risks, and both on the corporate side and the sovereign side are building up. I mentioned the labor market risks, the deterioration of human capital. Right now, financing conditions are accommodative and interest rates are low. So that helps with debt service, but should financing conditions tighten, that would be very difficult for many countries. On the flip side of that, with very low interest rates, we could eventually have the start of a buildup of asset price bubble, but that's probably a bit in the future. Of course, there's the policy risk that governments stop putting in the necessary support, especially on the fiscal side, or they withdraw it too soon. And in terms of exit strategy, I would say, well, for now, we're not there, but eventually, as conditions permit, governments may be able to move from a broader type of support to more targeted support.
Well, thank you very much, panelists, and thank you very much, audience, for your questions, which I've done my best to do justice to. So now over to Clare, please, to, I guess, close the session.
Yep, I'll be quick because we're over time, but huge thanks to all our panelists today for sharing their thoughts with us. We got some really different perspectives on the crisis so far, what we're seeing, both that's in the economic data, some really interesting analysis of the cost benefits of interventions, and also on the sort of risks of scarring and the longer term impact. So I'm incredibly grateful to Janet, David and Valerie for their input this afternoon, and to all of you at home for participating and watching. Thanks ever so much. Bye bye.